Hello and welcome to Mergers and Acquisitions Bootcamp. My name is Amy Hollenkamp. I'm with USI Insurance Services, and our private equity practice has partnered with Boulay and the Boulay Transaction Group to bring you this three-part series. Today, we're going to be providing some education and training on post-close and audit readiness. I just want to mention a couple of things. As you have questions throughout the presentation, please feel free to use the Q&A chat box and we'll address those either following the presentation or throughout. We will be also providing a link to the recording. If you missed the first part in the series, feel free to reach out and we can provide that link. We'll be having our third and final training on June 21st, so save the date for that as well. Last but not least, I want to introduce our first speakers in this session, Dan Gerhardt and Clay Brownlee of the Boulay Transaction Group.
Thanks, Amy. Yeah, I'm Clay Brownlee. I'm a manager in the transaction group at Boulay. Boulay is a regional accounting firm, full service CPA firm. We've got around 35 partners, just over 200 professionals. We have offices in Eden Prairie, Minneapolis, Naples, and we recently opened a small office in Mankato. Our transaction group is primarily focused on the lower middle market. We do a variety of services: financial due diligence, structuring assistance, valuation, and then Dan helps in that post-close accounting, purchase accounting area. You can jump to that next slide, Amy. So this is really just an overview of our transaction group and some of the items that we help with. I primarily focus in the quality of earnings analysis and the financial due diligence. And then Dan Gerhardt, he's really focused in that purchase and post-close accounting piece. Dan, you want to kind of introduce yourself and go through what you typically help with?
Yeah, you can jump to the next slide, Amy. My name's Dan Gerhardt. I also I'm a manager here at Boulay and work in the transaction group. I primarily work in the post-close accounting. It's a service line we started in 2021, and it's really been a help to our clients in regards to all those post-close matters that are a very important part to not only your net working capital true-ups, but your monthly reporting and your annually reporting requirements as well. So a lot of what I'll do is work on purchase accounting technical guidance, the flow of funds accounting, assurance readiness consulting, net working capital, and other true-ups. And then we'll assist with the dispute support as well on items such as the net working capital true-ups. When it comes to the earnout calculations, those are types of things where we'll help our clients get them introduced to valuation specialists so they can start doing valuations on earnouts, contingent liabilities like that, other things like intangibles and other assets and liabilities that'll be allocated with the purchase price. And then kind of from there, once I kind of get done with that, then we'll team up with the audit and tax departments to make sure there's a smooth transition there. You can go to the next slide. So this first slide here is I won't go through this entire slide, but it's just more for illustrative purposes. What a 90-day true-up might kind of look like from start to finish. Most important thing off the bat is identifying what that timeline is. It could be anywhere from 90 days to 120 days. It's whatever is outlined in that purchase document. And as you can see here, it's very important early on in the process to identify that internal accounting staff and management to kind of take the lead in the process. And then Boulay is really here to help guide you from day one all the way to day 90, and then beyond that with any disputes or anything else that might come up. So we're really here to assist in any way we can. And it's it's really across the board for me, how much I'm involved. In most cases, it's pretty heavy, but sometimes it can be as simple as just assisting with that process and helping review and understand as the process goes to make sure everything is in accordance with how the final purchase documents are outlined and everything from that standpoint. So Amy, go ahead. Thank you. So kind of from an illustrative next step process, it's again, like we showed on the previous slide, it's understanding that timeline and determining those key dates, because that's really just gonna, there's just so many things going on after or post close that 90 days just, it comes quick. So, or 120 days, whatever it may be. So it's establishing that time frame, who's the point of contact, who's going to be assisting in what, and keeping everybody on the same page, and just understanding those key dates. And then when your 90 days or 120 days is up, you deliver the product to the seller. That starts their timeline of any potential disputes with what has been presented at that time. It's also important obtaining the estimated closing calculations and final purchasing docs, because this is what's really going to outline all the definitions and methodology for that net working capital true up. So understanding kind of your starting point and what caused the changes. Is it, some of it might simply just be point in time from estimated was 3 days prior to close, where you had 3 days of operations in between, to everything that might have been missed from, accruals or other kind of time sensitive matters. Also important to get an introduction. If we're working on it, it's identifying and getting introductions to the internal accounting personnel. So then you can work with them directly to make sure that they understand that methodology and what that final calculations really needs to, how it needs to be presented, just based on those definitions within the purchase document. And then finally, we can help assist working with the client attorney and just making sure that the final schedules and statements are prepared in accordance with that final purchase document, and that the attorney is the one kind of turning that over to the seller, just so we're not involved in the negotiation process. We're just kind of assisting with the process of getting the information together. So how can we help prepare here at Boulay? Well, by allowing us to help review and draft these purchase agreements and working with your internal finance leaders, it's really going to just bring all this together and make sure everything's really efficient, and that we're capturing everything that might have been found in that due diligence process as well. Because a lot of the clients I work on, we're doing all the due diligence as well, and it's just makes things really efficient from that standpoint.
Yeah, and to Dan's point, typically when we wrap up our buy side project, for example, on the financial diligence side, as it approaches close, we always stay in contact with the client to review these draft purchase agreements, draft lending documents, because we know how that's going to impact them post close, depending, one, some of those key findings that we had during diligence, we want to make sure that the proper terms are included in the purchase agreement, so that when Dan starts into his work, it matches up with our expectations and the client's needs.
Yeah, thanks, Clay. And that's a good point what Clay raised there. When they're doing all the due diligence work and they're identifying those key risk areas, it really helps me be efficient on what those key risk areas are, and work closely with the internal accounting staff specifically on those areas. But then, it's also inquiry and analysis with internal accounting, and then review of historical financial records as well is gonna help understand kind of that point in time presentation that we need for the net working capital true up.
Yeah, and when Dan's working through his work, typically when we're able to do the financial diligence and Dan is involved and oftentimes handing it off to our audit team, it allows us to create those efficiencies and and Dan and I to meet and talk through our key findings, what we noticed about their historical accounting practices versus, what needs to change. If new code is going to be under, GAAP requirements, with lenders and investors.
Thanks, Clay. Yeah, and then you're also going to want to consider, what is that closing date and how can that impact and make a difference to those working capital accounts? A lot of times we'll see where they try to, pick more of a end of the month date for a clean cutoff, but a lot of times we also see kind of mid-month closing dates, and that can impact accruals or even, revenue recognition. If they're billing at the end of the month, it's prorating that over time revenue or capturing what point in time revenue happened up to that date that was billed later. It's all those types of things that we consider and help ensure that the client's aware of and capturing appropriately. So then kind of once we gather all that information with the client, we help assemble and the final closing statements, and then we retain all this documentation, and we're prepared should the seller come back with any disputes, so we can assist in getting through that as well. So then once, net working capital is kind of the primary focus up front, just to get that going. It has a little more time sensitivity to it, but we also typically I'll get going on the flow of funds and purchase accounting with the client as well. And the reason for that is we don't want it to be 90 days out before they really get their internal accounting and processes set up cleanly for internal financial statement preparation. So as far as flow of funds and purchase accounting go, your key documents are really going to be your final purchase agreement and applicable schedules. There's always a lot of drafts out there, so you really want to make sure you get that final purchase, because the smallest changes can have such a significant impact to that. You want to obtain the finding lending document, so you know at what level of that entity structure is really holding that debt, because it might matter. We'll get to that in a little bit here below. You want to obtain the capitalization table, so then you understand all the shareholders, and then it's always good to have subscription agreements and all the operating agreements as well, so we have an understanding of, on that cap table you might see some cases where there's a step up value for some initial capital raises where their tax bases might look different than GAAP bases, and so it's accounting for that appropriately. Then you get the flow of funds from the buyer. Sometimes that can be generated internally if they're doing a lot of the wiring themselves. Otherwise, in most cases, they're using their law firm or a bank to assist them with that, and they put a nice schedule together. That's going to really outline the total purchase price, what deductions came out of that, where does that flow in between each entity structure, your transaction related invoices. That's going to support what are acquisition costs that should be presented at the buyer level, what were the debt issuance costs that should be capitalized, and where did the lawyer have any, if there was debt involved, did the lawyer have any time into that as well, because you want to break that component out and capitalize that as well.
Yeah, and Dan, when you talk about what entity holds the debt and what does the lending agreement look like, can you talk a little bit about why that matters?
Yeah, it can matter, definitely. Every entity structure is different, but it's going to matter primarily for reporting purposes. So if it's let's say it's at a holding company level of an operating company underneath it, well, that's going to have to be consolidated, and then all the covenants are going to run up through there as well. So it's just having a basic understanding of what are the reporting requirements because of that lending agreement, and what are those covenants that are in place, and what are kind of the due dates and everything else of that nature. Acquisition date, I mean, that's obviously matters as well. A lot of times on these purchase documents, it'll have kind of that closing date, and then there's also within that, it's going to have either like a 12:01 a.m. or a 12:59 p.m. Well, that's pretty key to understand that as well, because I've seen it where that kind of day of operations comes into play and there's some confusion around that. So it's who really gets that day operation, whether it's an AM or a PM type thing. And that's the purpose for that time sensitive dating on those documents as well. As I talked about a little earlier, those debt issuance costs, make sure you're gathering all the information for that. It's going to be pretty easy from the lender. It's going to be on the statement, but it's that legal portion. It can be pretty significant if you have a large acquisition and we're heavily involved in the debt component of it. It could be 20% of that invoice. And then other considerations, ASC 805 business combinations. So all your assets and liabilities have to be at fair value. So again, with that, some of those items, it's getting you in touch with a specialist that can help you identify and value those assets and liabilities appropriately. And then we also, can help out with measurement period adjustments. So it's good to get kind of a rough draft going up front and then just kind of highlighting those areas where we know there's going to be some pending information coming in on that fair value to further break out the goodwill component of that purchase price. So how can we help? Well, again, if we get the final documents as soon as possible after close to begin the process. So generally we'll get the final closing documents, flow of funds, bank statements, all that information combined. And then we'll start with the entity that the monies came from, and then trickle it all the way through down the operating company level. So it's very important that each entity has a set of books. A lot of times we'll see that, ultimately the business acquired is the only business that they're really keeping track of, when you got all these entities above it that need their own set of books, and that income is going to trickle all the way up as well. So likely they have different tax returns and other various reasons where they need to have clean books. And ultimately it's probably going to be a consolidated audit requirement as well. So having that all done properly up front is pretty crucial in the whole process. So it doesn't create any issue at the end. Involving the necessary parties during the closing process, having an internal finance leader in place. Having somebody take ownership early is very important as well. We've seen too many times where this doesn't happen, or maybe they don't want to pay for the service, but we get to the audit comes around and things there was never a month-end close process put into place. They didn't really identify any process and procedures, segregation of duties, basically all of that. And once the audit comes around, it's a really messy audit, and it runs the fees up as well, and just can cause other issues such as, covenants to fail because they weren't tracking everything as they should have been on a GAP basis.
Yeah, and to Dan's point, one of those issues that we see is, if that internal finance leader isn't identified or brought on, it makes Dan's process much more difficult because he really needs someone in place to be able to approve of a lot of his work. And then also, some of the issues we see is not only that audit can become really painful, are the financial statements that you're delivering on a monthly or quarterly basis prior to that audit, are they going to end up looking wildly different once we make all these gap adjustments, because there was really no one in place to change those historical practices to new practices that are going to line up with the gap requirements.
That's exactly right. Good point there, Clay. And if you don't have that internal finance leader in place, we have a lot of recommendations for fractional CFO services, bookkeeping firms, and valuation firms to kind of assist with all these items, and that we can work with directly as well to keep the process very efficient and clean for you. we can assist in preparing the data book outlining the purchase accounting based on all the standards. Again, in that position, we always make sure that we have that internal finance leader that Clay was just talking about. Because what we do is more recommendations. Ultimately, management has to make the decisions on all of this and provide that oversight. And then we work closely with the acquirer and the leader. Just if there's any other accounting standards that could impact that opening balance sheet or consolidations, we're just making sure that's very clear up front as well, and how they can account for that monthly and annually. And then finally, that kind of my last topic here is going from that purchase accounting into the assurance readiness. Really, the two kind of work alongside each other, because as you're preparing the opening balance sheet, that really matters for your assurance readiness and just all your financial statements going forward. Specifically, if you're have an audit requirement, it's going to be that opening balance sheet audit. Having that clean is only going to help things up front as well. But a lot of the common shortfalls that we see, it would be that improper staffing and management oversight. A lot of times some of these companies they just didn't have the accounting in place, and there wasn't anything set up at close to take that process over, and they're just kind of running on what they had. So try to identify that early in the process and just understand who is going to be that person or those individuals that are going to run that accounting process that we can work with.
Yeah, and when we're involved on the financial diligence piece too, this is where those efficiencies come into play when we're working on it and Dan's working on it. Is we can really we're working closely with sellers management and their current whether it's a bookkeeper or controller, and that's allowing us to identify where they might have some weaknesses in their accounting team. And we often find that there's certain documents that are just not retained that under an audit we're going to need to start retaining those and documenting certain things. And so those are the things that we can flag and help Dan identify and be aware of as he's helping the new company and the buyer put into place new procedures and processes.
Yeah, great point, Clay. Then another shortfall, a common one would be really prioritizing that close process and kind of a monthly reporting packages for management review. This often gets overlooked early as well. And it can be as simple as identify who's responsible for what, having them kind of set a day where it's due. Is it in correspondence with GAAP, each section of the balance sheet? Who's going to review that and sign off on it? Just kind of having that full process laid out each month and going through that, and have supporting documentation available. Similar to if you were undergoing an audit or a review, you're going to need all that information. You should have that internally as well, because it's only going to benefit the company to have that for more analysis as well, and just proof of clean processes and procedures. Misunderstanding of reporting requirements at each entity level. Again, a lot of times multiple entities involved here. They end up kind of missing the point that they have to consolidate at a higher level. They don't understand the concept of the business combinations and how that runs through each entity as well, potentially. So it's just gaining that understanding up front, so you know how to report at each entity level, and having that set of books. Can't stress that enough, at each entity level. And then finally, last not least here by any means, insufficient document retention standards. It's just having support for everything that's running through the financial statements, essentially. So having all of your reconciliations for each account that's necessary, your subledgers, your AR, invoicing, shipping documents, inventory, shipping documents, in and out, all of that information. It's going to be necessary for proof once you undergo an audit. and just again, in general, just having that information available. Best practices, kind of running out short on time here, so we'll run through these. How to avoid shortfalls. So work closely with your diligence team to identify those potential gaps in a company's accounting team. So as Clay mentioned earlier, they're involved early in the process, and they're finding out about a lot of these gaps early on in the process. So really gain that understanding with the diligence team well in advance of the purchase, so then you can have that kind of fulfilled by the time that close happens. Then considering your employee handbook, what are the current policies? Do you want to maintain that? We can help you identify necessary schedules and provide templates that assist in monthly reporting process. So again, I kind of laid out a very simple process, but it might seem simple, but those schedules that all tie into that checklist, it's all going to make that very efficient and very accurate on a monthly basis, so that everything's getting checked off and provides for clean accounting records. And also we'll work with management and the internal accounting team to establish best practices in regards to that document retention, segregation of duties, and month-end close packages. We can also assist with maintenance of fixed asset and depreciation records. Also, another thing that kind of gets overlooked at times, I mean, not a lot of companies have their own software that can do that, and it's just easier for us to take a short amount of time to input that data, because tax will likely need that as well. And then finally, formalizing procedures around physical inventory counts and fixed asset inventories. So whether that be cycle counts, full physicals at the end of the year, a lot of times these companies that are being purchased, they might not be maintaining inventory properly on the books. It might just be flowing through cost of goods sold, or they might not ever do full physicals. So it's gaining that understanding early, so you can do a count at close or around close, and then just going forward have kind of a process in place to ensure that your inventories are always accounted for, plus the stuff that's in transit as well. That's always something to consider based on if it's FOB shipping point, which we see a lot of times, that then it's your inventory. That's about all I got there. Happy to take questions now, or as always, feel free to email me, and I'm happy to help.
We do have one question in the chat here, and it's from Tim Heron. He asked, what are the most common disputes and what are common surprises from the estimated purchase price to final purchase price?
That's a great question. Common disputes, a lot of times we find a lot of unrecorded liabilities, just through the process of looking kind of through AP or just other things we might have identified as that 90-day window is occurring, which is also another point why we don't like to rush that process either, so we can uncover those as they come in that window. Other items might be deferred revenues is a pretty typical one too, just based on the revenue recognition policies. And that can be a tricky one, because, there's not a lot of knowledge behind that. So when you're if the definition is on a GAAP basis, and that's what you're really trying to get to, because it's almost like a debt-like item, it's getting to that final number and getting them to understand that they already received that money, but the next company that took over is ultimately, there's costs involved in that. And, they're going to be, they don't get the cash up front, essentially.
Yeah. And to Dan's point, I mean, those are the items that, we're working closely, assisting our client in educating them and the seller. If the seller doesn't have, the correct representation, is really making sure that everyone understands, how the working capital is written in the purchase documents, and how that's defined. And then even, say a revenue earnout, for example, making sure that, how we're defining revenue within that revenue earnout and that timeline matches up with everyone's understanding of the deal, because really the goal is to avoid those disputes.
Great. Thank you, Dan and Clay. At this time, I'd like to introduce Tamara Heydrich, who is our P&C private equity practice leader for USI Insurance Services. She'll be going over M&A and post-close considerations. Tamara?
Yep, thank you for having me. Thank you to my USI Benefits Group and the Bootcamp team. I'm excited to present to you some of my findings from all of the transactions and M&A activity that our group participates in on a daily basis. Just a quick highlight of USI in general. We are the second largest privately held broker, a global broker as well. We have a global broker network, so can reach any country. Over 200 local offices and growing, over $2 billion in revenue. USI stands for understand, service, and innovate. So you may not see us advertise a lot, but you will see us putting a lot of our dollars into our technology, our people, and our clients. A quick snapshot of our private equity practice. I reside here in Minneapolis. We have the largest private equity practice in USI and have several throughout the United States. We have at least 80 private equity clients. This is a little old, so I know that has grown quite a bit over the past couple of years. I like to say that we are, we're much like our large counterparts where we have the market leverage. We have all of the talent within our company from a cyber standpoint, D&O management liability, et cetera, but also have that local feel where relationships really do matter and service excellence really does matter. Next slide, please. Within our team, we house all of the services needed from a due diligence standpoint. So we do the front end due diligence on our team. We do the property and casualty. Wade Johnson, who spoke last week or the last webinar, would be a part of the benefits, and we also have retirement as well. We also work with that. Oh, thank you. We also work through the diligence process through program implementation, and then post-close services. So, any of our findings we find through due diligence, we would help implement through post-close activities and service those post-close clients afterwards. Along with that, if you're in a process of selling or buying a company, you would likely come across transaction liability insurance, which has become very commonplace in our world. Next slide, please. So I've highlighted a couple of slides here of what really representations and warranty insurance is. Really, it for a buyer, it helps protect you from any future financial surprises, and as a seller, it helps facilitate a completion of a deal and also helps eliminate and lower any need for escrow. It is growing as we speak. So currently, we have 20 plus insurers available in the U.S. The capacity for this insurance is very abundant. You can get 25 million in limits, 50 plus, depending on the deal. When you get quotes for reps and warranties policy, they're not going to vary too much from a pricing standpoint. It's all pretty much baked into the purchase price. So 3.75% or 5.5% of the overall price. Minimum premiums are quite large. So 200, 250, that used to be lower, that keeps creeping up. And then retentions are significant depending on the size of the policy, so 1%. So where the difference is in reps and warranties policies when you get different quotes is really the terms and conditions. So the pricing may vary, slightly, but exclusions will vary significantly. And that can really kill a deal. So from the process of you deciding to partake in a reps and warranties insurance, you have to put up a diligence fee, which is non-refundable, which goes towards your premium, but that ranges from $35,000 to $45,000. You also have quite a big process that the underwriters go through. They're usually M&A attorneys, internally at USI, we have attorneys on staff for claims and for brokering the deal as well. They would go through the diligence process, reading all of the diligence reports from tax, finance, real estate, insurance. You would also have a very long, boring call, about a couple hours, walking through all of their questions. And then there's usually a bring down call. So the process can take a little bit. So if that is something you're going to be partaking in, it should happen pretty early on in the process of vetting out which insurance carrier you're going to be moving with. The next slide, I have some statistics for you. About 60 to 70% of the transactions of larger size, 50 million to 2 billion, do typically purchase reps and warranties. A lot of the smaller deals are also participating in buying this coverage. Again, it helps facilitate the purchase. So a seller will require a buyer to buy reps and warranties so they don't have to deal with claims in the future. Again, the escrow need, and also from a buyer standpoint, really to enhance their offering. So maybe they get the deal. Most of the transactions that are in the smaller revenue range, you'll start seeing some of the terms and conditions lessen. So it may not be advantageous if you get below 20 million in enterprise value to look at reps and warranties, because the diligence might not be there, and the terms and conditions are so sort of lots of exclusions. So the price of the policy doesn't really make sense. About 20% of the policies purchased have had claims activity. And I kind of go into this later on, but most of the top 5 claims that have come out with reps and warranties deal with financial statements. The next is tax, next is compliance and laws, material contracts, and then employee related. Next slide, please. I did go into our reps and warranties practice to get the current landscape for the call today. So right now, activity is down roughly 10% from record high levels at the end of last year. There's no impending significant tax laws that are driving the M&A activity. And then Russia and Ukraine has reduced or slowed the pace of large transactions, especially if they're global entities. The carrier landscape. So carriers have hired a lot of M&A attorneys to underwrite these risks. So therefore you are seeing multiple quotes, where at the end of last year, either they wouldn't quote on smaller deals, or you're maybe getting one quote. So you're seeing multiple quotes come, which is a positive, which also then helps sort of soften the landscape. So we're seeing some reduction in pricing as well. Claims activity, we already spoke about, 20% roughly. And then pricing, again, premiums flat to down 10% from 2021 levels. So, as you've closed a deal, whether you've sold a company or bought another company, there's several considerations you need to think about, because there's a lot that goes into once a company is now under new ownership. So a couple of those things are, what is the ideal program structure? For my private equity clients, does it make sense to have a one program where several companies fall into one program? Or does it make sense to have several different programs, but some sharing of possible carriers, brokers, et cetera? Another consideration to think about is captives versus guaranteed cost, loss sensitive versus guaranteed cost. If you can go to the next slide, I highlighted some of the differences there. So this is a risk financing alternative sort of continuum. From the bottom left corner is where you take on little risk. It's a guaranteed cost program. The carrier essentially takes on the most risk, all the way up to captives, which you take on more risk. You do gain some benefits from potential savings, and then of course self-insured, and then everything in between. From a private equity standpoint, we don't see a lot on the right side, because the right side does require collateral. And if they're looking to sell a company within 5 to 7 years, that is not something the most private equity firms are interested in. So it's really something to consider if you're looking at more of a loss sensitive program for the future. That is really a long-term decision. It is not something that is a short-term gain. Next slide, please. And then the next bullet points here, insurance program implementation. During due diligence, we may find that certain insurance policies aren't in place. Limits may not be adequate, or maybe you're a company that's buying. Thank you. Or maybe you're a company that's buying another company and bolting it onto your current program. Those are things that your broker is going to need to help lay out how that program should look going forward. Do you roll in the other company's program into your current program? Do you leave them separate for now? Do you have standalone programs until the other programs expire? Another item to consider is policy wording, making sure all entities are covered. If you're a private equity firm, making sure that the private equity firm is covered under all of the policies. And then also future considerations. So for management liability programs, that program gets tailed out during a transaction. So pre-negotiating those tail premiums is key and something we put in place at the time of transaction. So you're not negotiating those terms if during a sale. Cyber liability is the hot topic of the day. And during reps and warranties discussions, during due diligence, is probably the most important policy that we're reviewing as of late. It is a very difficult, hard market. It's very difficult to get multiple quotes. It's very expensive. So there's a lot of due diligence that needs to be done on controls, what the program looks like, what the wording looks like, is there ransomware coverage? And if there isn't, how are we going to put in place the appropriate coverage post-close? For rolling considerations, if you're going to have a bolt-on, you can't just add in your company that you're buying, ABC company, into another company. You have to consider when the systems are going to be integrated. Do they have controls in place? So it's not just a simple, we'll cancel this policy and now you can be covered under the parent company. That's not how it is anymore. So there's a lot of due diligence, a lot of underwriting that is done from an underwriter standpoint that wasn't done 2 years ago. 2 years ago, we were able to just roll it in without even considering anything to do with another company. I talk about cyber hygiene here on the next slide, I believe. Oh, I'll get to that. Keep going. One more. Thank you. USI has put together a top 5, next 5 for cyber hygiene. It's good internally if you're looking to sell to make sure that you have all of these factors in place, because they will be looked at from a diligence standpoint, from an underwriting standpoint, from a reps and warranty standpoint. Do you have multi-factor authentication? If you don't, it's a problem and you may not get coverage. And if you have coverage now, you may not get it going forward. Along with endpoint detection, 24/7 network monitoring, network backups, network segmentation. Those are the top 5 that carriers have been looking at for the past 1.5 years, where they weren't scrutinizing it prior. The next slide has our next 5. So as the cyber market has evolved, they've become even more detailed in what they're looking for from a cyber hygiene standpoint, from a company and from companies that are being acquired. That would include pen testing, PAM, privileged access management, email security solutions, who's your vendor, as well as headline mass impact events like the Chronos, SolarWinds. Were you impacted by that? Do you have them within your company? So all of these should be looked at pre-diligence. If you don't have them in place, should be put in post-diligence. And any companies looking to acquire, you should be reviewing and making sure that these things are in place. So for an easier transition in. Can you go back to the market Go backwards. Sorry, Amy, I'm testing you here. One more. I skipped over market outlook. One thing to consider when looking at your company, looking at selling, looking at buying companies, is the market will affect what you pay for insurance premiums. So, and it'll be changed depending on industry. So if you are, you know, a manufacturing plant that has a lot of exposure in cat prone areas, you're going to be affected by the property market and the hardening property market we're seeing there. Similar, you know, everyone's seeing a hardening cyber market. Everybody's paying triple the premium, having triple the retentions, et cetera. But all of those should be considered when looking at either selling or buying. How is that, you know, what the insurance is right now? What's it going to look like post-close? What's it going to look like in the future? What things can I do for my company to make sure that I am not following the volatility of the market? Are there ways that we can do loss control to help mitigate losses so we don't fall into the, you know, heavy claims buckets and now I'm paying 30%, 50% more than my peers? So the market forecast is quite important when looking at selling or buying a company. USI puts a report out every 4 or 5 months. We usually do a midterm one that's coming out here soon, and then an end of year, either look back and forecast for the next year. And with that, we usually highlight what the rates look like prior year end to going forward. So you have some sort of idea of what your insurance could look like, and it can be significant. Move forward. I've been watching for questions and have not seen any. Again, I'm Tamara Heydrich. I do the private property and casualty. My counterpart, Wade Johnson, does the benefits for private equity. If you guys have any questions, feel free to reach to us directly or post a question. I'll keep an eye out as well.
Thank you, Tamara. And unless there's any questions, we appreciate you all joining us here today. Please save the date for our final educational webinar in this M&A Bootcamp that'll be held on Tuesday, June 21st. Appreciate your time. Take care, everyone.